The remarks I'm going to make are based on a book that's going to appear in August or September that I wrote with Nicola Gennaioli called The Crisis of Beliefs, which is a book, largely a theoretical book, but also a book about motivated and spending a lot of time in the financial crisis. So you should all buy it, even if you don't read it. So the main points of what I want to make are basically three, and they're very much addressed to the question of what have we learned in the last 10 years. The first is that there's been huge revival of research on credit cycles, which shows that financial crisis or financial credit cycles follow very predictable patterns of credit expansions and crises that don't happen suddenly, but rather arrive at a rather deliberate speed and are in part predictable. Second, I think what we've learned is that the US housing bubble and the crisis of 2008 look very much like a standard credit boom, followed by a crisis and a recession, and I'll try to illustrate the facts of that. And the third point, which is what I think is probably a little more novel to what I'm going to say, is that there are also patterns of expectations and beliefs that evolve over the course of the cycle, which are an important part of the predictability, but also are pretty standard in the 2008 episode and similar to the ones earlier. So let me just summarize some of kind of what I think are the highlights of research on credit cycles over the last 10 years. So this is from a study by Shleifer and Taylor on the predictability of financial crisis. And on the x-axis, you have the change in the credit to GDP ratio over a 5-year period. And then on the y-axis, you have the probability of a financial crisis. And the point of that paper and that study is that the bigger is the credit expansion, the more likely is the financial crisis. This is from a study of Mian, Sufi, and Werner, which looks at a similar issue using household debt data rather than all credit, and it looks at growth of household debt on the x-axis and GDP growth in the future period on the y-axis, and again shows that there is a fair amount of predictability, which is to say rapid expansion of household debt tends to predict slowdowns in economic growth. This is from a study of Jeremy Stein and his colleagues, which looks not at credit expansion, but at a measure of credit market sentiment developed by Greenwood and Hansen on the y-axis, and looks at the relationship between the level of sentiment, and I'll talk about that a bit later, and future growth in real GDP, and again finds the highest level of credit market sentiment or high levels of credit market sentiment with some reliability predict declines in GDP growth. So there is a thing called credit cycle, which is to say when we see credit growing, when we see high indicators of credit sentiment, that portends slowdowns of economic activity going forward. Now, there are kind of two very broad views, and I'm now painting with a very broad brush of understanding this phenomena. There is the traditional view, which I tend to associate with Bernanke and Diamond Dybvig, which is that you have an economy which is kind of rolling along. There is a bad shock, which could be bad fundamental news, a sunspot or whatever, that gets the financial system to begin unraveling. There are all kinds of amplification mechanisms, adverse selection, agency problems, fire sales, and that this, through the credit channel, leads to a recession, which is to say, in these models, expectations tend to be rational, and crises amplify bad news. There is an alternative view, which is, I tend to associate it with Minsky and Kindleberger, which is that a big part of financial instability comes from beliefs rather than from rational expectations, and that the growth of credit and the high levels of investor or credit market sentiment are associated with, driven in part by extremely optimistic beliefs, that when there is news leading to the corrections of these beliefs, or perhaps because beliefs self-correct, because things are not as good as people expected, there is a correction of expectations that leads to the unraveling of the financial system and the recession. I mean, the two views are not that different in terms of how things fall apart, but they are very different in terms of how the system, how the pressure in the financial system gets built up, and how the crisis begins. So what I would like to show to you is that at least, the weight of evidence, I'm not saying anything is conclusive here, has been shifting toward the second point of view and away from the first. Here are kind of my three random, but three of my favorite studies that show that, in fact, errors in expectations are important for understanding this phenomena. The first is from what is now a classic study of Greenwood and Hansen that looks at the measure of credit market sentiment, which is the blue line, which is the share of high-yield bonds, of risky bonds, in the total bond issuance. So this is a quantity-based measure. You also have price-based measures. And what this graph shows, what this picture shows, is when that measure is high, when there's a lot of issuance of risky bonds, the return on these bonds going forward is low, which is to say there is some indication of overpricing of risky debt at the time of buoyant credit markets. This is from another aspect of debt, which is the banking sector. This is from a study of Barron and Chong, which shows that, in fact, if you look over the course of credit cycles internationally, you see evidence of the fact that as credit expands and banks increase their lending, the stock market is cheering for the banks, and they earn very high returns on their equity, and that this credit expansion and high returns on banks actually predict poor returns on banks and poor performance going forward. So again, some pretty direct evidence of errors in expectations coming from financial markets. This is from a paper which is right off the press, actually, is from Stefano Rossi and his co-authors, and he does something which economists, again, this is what we've learned from the crisis, have now done increasingly, which is look at the expectations data. And to try to ask, what were people thinking, what were they expecting? One of the strongest predictions of the rational expectations hypothesis is that changes in beliefs cannot be predicted. Okay, which is to say, I cannot use information available today to predict how your beliefs are going to change from tomorrow to the day after. Okay, that turns out to be not true in a lot of data. And this is an association between the same measure of credit market sentiment that Jeremy used and Greenwood and Hansen used on the x-axis. And on the y-axis is the change in analyst forecasts of earnings growth of companies from year T+2 to year T+3. And what it says is that when credit markets are buoyant, you can predictably expect analysts in the future to revise downwards their expectations of earnings growth of companies. So this is evidence from expectations data that good times predictably anticipate reversals in beliefs in a way which is not consistent with the rational expectations hypothesis. So this is kind of the Kindleberger-Minsky view. Expectations drive bubbles, credit cycles, and predictable, not again predictable with probability 1, but predictable reversals. So how does crisis of 2008 fit into the picture? How does it compare? And so the question I'm going to ask is, first I'm going to look at what happened at the crisis, but then I'm going to try to also look at what is the evidence on beliefs of the participants in the financial system. So this is the picture which I assume everybody has seen, which is this is Shleifer's picture of the housing bubble, which shows that real home prices in the US being relatively constant until the mid-1990s, and then experiencing a massive increase until 2006 or so, and a collapse afterwards. This is what is commonly referred to as the housing bubble. This is, again, a very standard picture on the fact about credit expansion during the housing bubble, and the fact that US household debt outstanding rose from less than 4 trillion to almost 14 trillion at the peak. So again, as in a standard credit cycle, you have massive expansion of household debt. This is some data on the role of subprime debt or risky debt, which of the sort that Greenwood and Hansen were talking about, but in the household level in credit expansion. And you see that what has increased most dramatically, perhaps, right close to the peak of the credit bubble, is the issuance of securitized debt, and the share of subprime mortgages in that securitized debt was extremely high. So again, in terms of credit expansion, the whole thing looks pretty standard. What about going forward? Well, this is, I'm sorry, one more picture, which is that parallel to the increase in leverage of the household sector, you also see increases in leverage of the financial institutions. This is from a study by Hyun Shin and Neil Kashyap and others on the growth of leverage in the US financial system and investment banks. So what happens in 06, 07? Well, what happens in 06, 07, you see this from the Schiller picture, is that home prices begin declining, or the growth of home prices stops before home prices begin to decline, and then you see an increase in defaults on subprime mortgages. So this is from a study by Chris Palmer, which shows that the fraction of the cohort that defaulted of mortgages issued in different years, and you see that, of subprime mortgages, I should say, that for 2006, 2005 originations, these numbers ended up being just colossal, which is to say that there is bad fundamental news that start coming in 06, 07 regarding the defaults on mortgages, regarding the path of home prices, and the credit cycle begins to unravel. This is, again, a very standard picture on what happens. This is the prices of mortgage-backed securities of different levels of riskiness, with the red line being the safest one, and so on. And what you see is that starting in the summer of 2007, and this is really important for thinking about the financial crisis, the bubble and the financial system slowly begin to unravel. And I want to make the comment that it's very, very slow. So you have the first tremblings in financial markets in the summer and the fall of 2007. They get patched up, as I'll show you, by the Federal Reserve. And then you have a period of close to a year in which nothing too dramatic happens. But the first bad news, seriously bad news in financial markets and the housing happened in early to mid-2007. Now, what happens after that is that you have the usual correlates of the what we describe as a financial crisis, but you don't get a financial crisis. So this is what happens to asset-backed commercial paper market, which is one of the main short-term borrowing market, financing mortgage-backed securities. And you see that this market essentially disappears in 2007 or collapses as the holders of MBS are unable to maintain their positions and have to sell them. This is the twin side of the decline in prices. You see in 07 and early 08, huge increases, or this is the middle of this picture, in volatility. But again, the system does not collapse. Why does the system not collapse? Is because, to a large extent, the Federal Reserve begins a very aggressive series of policies providing liquidity to financial institutions, creating new liquidity facilities that prevent the wholesale liquidations of positions for financial institutions. And so for a period of a year, banks are losing a lot of money, home prices are falling, there are rescues of some financial institutions by Bear Stearns, but the system holds together. The system holds together, so this is again a slow arrival of the financial crisis, not a one-moment arrival. That is very typical in other episodes as well. And the system holds together until September of 2008, when Lehman goes bankrupt. And there are many people who've written about the Lehman bankruptcy and why it's pivotal, and whether it was a mistake, whether it was not a mistake. That's not the subject of my comments. But it clearly was the pivotal event separating this period where it looks like the government was able to keep things together to the period where things really fall apart. These are some correlates of Lehman. You see the flight of short-term money from prime money market funds to government money market funds, which is to say that investors fly to safety. You have many other correlates. One thing to make sure, again, since the question is what's new after the crisis, is that people in finance understood these mechanisms of unraveling of the financial system extremely well, even prior to the crisis, which is to say the mechanisms of fire sales, liquidations, increases in runs, increases in margin requirements on short-term debt, and what Brunemeyer and Pedersen called liquidity spirals in a very nice paper which was written way before the crisis. All of this happened just like financial economists understood. There were some new and important elements. There were dramatic failures in derivatives markets, which I think Gerald Duffy will talk about. But the outline of how things unravel was pretty standard. This is just a picture about the importance of fire sales in the mortgage-backed securities markets and the dramatic declines and then subsequent increases in prices of AAA-rated RMBS. Now, here is a slide which I think, again, speaks very clearly to the point that the crisis had a long time coming and was not some kind of a surprise or some unanticipated shock that resulted from Lehman. This is a time trajectory of IMF forecasts of the losses for the world and US banking system that were anticipated from the time that home prices started to decline. So in October '07, the IMF forecasts $200 billion of mark-to-market losses on asset-backed securities and CDOs and US banks. In March 2008, this estimate gets raised to $720 billion total, $200 billion for US banks. In October 2008, these are the estimates made actually before Lehman. The IMF predicts $1 trillion in global losses to financial institutions and $400 billion in US bank losses. The reason I'm mentioning this is that by the summer of 2008, and probably before, the evidence is pretty explicit that the financial system is in very, very deep trouble. okay? And it comes from IMF, it comes from security prices, it comes from many other sources. And that's a very important point, I think, to keep in mind. So that's the story. What I hope I've shown you, again, is that the US financial crisis looks like a very standard credit cycle with a bubble, credit expansion, some bad news and disappointment with respect to the housing bubble, and a very slow unraveling of the financial system, followed by a collapse in September of 2008, and then very effective government rescues, but which nonetheless do not manage to prevent a deep recession. So the question is, what were the beliefs? What were they thinking? Why did the bubble and the crisis follow the path that they did? And what I want to show you as the last piece of this presentation is that, in fact, expectations or beliefs, and in particular inaccurate expectations and beliefs, play a very central role in understanding the evidence. Now, there is now growing amount of evidence on beliefs during housing bubbles. Many people in this room have contributed to this. One of the first papers, which is the one that's summarized here, comes from Bob Schiller and his collaborators, who've conducted surveys in 4 US counties of beliefs about home price appreciation. And they asked a very simple question of, on average, over the next 10 years, how much you expect the value of your property to change each year. And what you find is that during the 5-year period before 2008, these are the averages for annual expected growth rate. People expected home prices to grow 10% a year, okay, which is pretty extraordinary expectations of home price growth. And again, we've now seen a lot of evidence from many countries that a central feature of housing bubbles and credit cycles is these very optimistic expectations about home prices. As I mentioned, another central piece of the story of this crisis, the conversion of mortgages into mortgage-backed securities. This is another one of the canonical pictures of the financial crisis, which was, I think, found first by Paul Willen and his collaborators at the Boston Fed, which is from a document, and you can think of this as a sales document, but there are many other documents like that produced by Lehman Brothers Fixed Income Research in 2005 on the future path of defaults and potential mortgage losses in the US economy. And what you find is, of course, a picture of complete insanity. So they expect that there is an 80% probability that nothing bad's going to happen at all, and home prices are going to keep growing, maybe at a slower pace, which of course would lead to very small losses to the riskiest tranches of mortgage-backed securities and total safety of AAA-rated securities. They attached some probability to pessimistic and meltdown scenarios, something like 20%. But again, these scenarios turn out to be vastly more optimistic than has actually happened. So at least if you look at the data on expectations on mortgage defaults and losses, they appear to be utterly unrealistic during this period as well, both in terms of totally ignoring not being able to understand the worst case scenario and also attaching too low probability of bad outcomes. Now, the last 2 pictures on expectations I want to show in terms of what people are thinking is what were the professional forecasters and the Fed thinking over the course of 07 and 08 as home prices began to decline and there were defaults on mortgages and significant reductions in prices of MBS. So this is from the survey of professional forecasters, and the way to read this picture is that at any point in time, I show in with the light line the forecast of growth over the next year, and with the dark line, the actual growth over the next 12 months. Okay? And what you see in the survey of professional forecasters is that even as late as the summer of 2008. Okay, this is really quite important. Even as late as the summer of 2008, people expect continued real GDP growth over the next 12 months. Okay, the reality, of course, is minus 4%. Okay, so the professional forecasters completely missed the risks, the downside risks building up in the United States economy. What about the Fed? They have much better information. Well, you see the same story. Again, the light line is the forecast. The dark line is the reality. The black square is the July 30th, 2008 Green Book forecast for the August 5th meeting of the FOMC. And you can see that at that meeting, the forecasters at the board increased their forecasts of the growth of the US economy to something like a positive 1%. Okay, so I mean, you have to take this data seriously if you want to understand why the crisis was such a surprise, why the system unraveled so rapidly. So at least at their main forecast, the Fed forecasters completely missed what was about to happen. It turns out that it gets better, which is that one of the governors or whoever asked the Fed forecasters to prepare a scenario, what's happened with the scenario of severe financial stress, which is this is the scenario in which credit losses and solvency concerns intensify for many financial institutions, blah, blah, blah. So the Fed forecasters predict in this scenario that there'll be expected minus 0.4% real GDP growth in the second half of 2008 and rising at 2009 to positive growth with unemployment peaking at 6.7%. Okay? So 6 weeks before Lehman, the Fed forecasters had no idea what was coming, okay? And if you actually read the discussion of this, there are a bunch of presidents of regional Feds who accuse the Fed forecasters of being too pessimistic. So, you know, either you think this is useless information because who cares what Fed forecasters forecast, or you think that there is a problem with how we think about this. So what are the bottom lines? The tail risks appear to be neglected by both investors and policymakers. Liquidity interventions, but there were no aggressive attempts to get banks to raise capital despite all these enormous losses. So the reason that Lehman was so important and the system has unraveled so rapidly is that markets learned that, in fact, the financial system was much more interconnected through various mechanisms than people thought. And so Lehman precipitated this learning, this change of beliefs that was so central to how the system unraveled. And this is what we try to go through in detail in the book. Let me just say 2 words about alternative theories, and then I will conclude. You know, here are the theories which all of us in this room love, but they're largely wrong. One theory is moral hazard. I think the central fact about the crisis, and Wagan has worked on this, is that the banks, the regulators, financial markets all believe the same thing. Okay, so the idea that somebody was tricking somebody and taking advantage of them and had some special information about what was going to happen, that idea flies in the face of all the evidence. The second idea, which is equally appealing but equally wrong, is that the crisis was just a bank run. It is surely the case that at the end of it all we saw a bank run, but that is at the end of it all, after we've had years of a bubble and a very, very slow deterioration of the financial system. To say that the crisis was a bank run, you know, when you look at hospitals, 90% of the people die of cardiac arrest. But, you know, that's not the reason they come to the hospital. They come for many reasons, then they die of cardiac arrest. So that's the same thing. It's the final collapse, but that is not what the crisis is. Okay, so just the last slide. So what are the main lessons? I would say there are 4 lessons. Extrapolative expectations are central to the housing bubbles. The continued neglect of downside risk is very central to understanding this delay period of 2007, 2008. Economic policy was obviously brilliant and fantastic after Lehman, but I think all the evidence suggests very clearly that it was behind the curve between 07 and 08 and not fully appreciating of the risks building up in the system. And it seems to me, and that's, I guess, my main punchline, is that it's very hard to tell the story or to piece the story together without following the evolution of beliefs of both policymakers and market participants. Thank you very much.